Okay, it's a few minutes after the time. And so, first of all, welcome everyone to our Bucks County Score webinar program. This is one of 35 webinars we're putting on for this calendar year, September to September. And for the next calendar year, we'll be posting about 40 of them. So I think we're trying to make it as informative, as interesting as possible on as many topics as we think small business owners really need to know. The topic of today, I think, is I will tell you in a minute. First, I'm just going to give a 1-second commercial on SCORE. SCORE is a national organization. It has 350 chapters, about 10,000 mentors, and in Bucks County, we have 75 members. SCORE is also affiliated with the Small Business Administration as they fund a little part of our organization. Our mission is very simple. It's to help small business to either start a business, grow a business, or thrive a business if you already have one. You can get further information on what we do, and if you'd like a SCORE mentor to help you. And as you know, there is no charge for our mentoring service. You need only go to buckscounty.score.org, and the site prompts you to different places to go. If you'd also like to volunteer to be a member, go to the same site, and right there you will find a prompt to show you where to go. Just so you know, this session is being recorded, so you needn't take notes unless you want to. And right after the presentation, we will send you a copy of the presentation and the slides. Please, when you have a question, which we hope you will, just click on the little Q&A icon at the bottom of your screen and put your question in there. At the end of the session, I will read the questions to the appropriate presenter, and this way everyone will be able to hear it. With that, I just also like to introduce our two presenters. First of all, hopefully a number of you were on our prior presentation, which was on May 4th, which was how to buy a business. And this is now maximizing your profit when selling a business with legal help. And our two presenters, the first one is Steve Wilson, who's retired but a former business owner, and he's a certified SCORE mentor. And he has run a number of businesses, including at the end, he purchased and ran a 150-year-old wholesale distribution company for contractor products. And he has handled all types of operations within that, and he's done this for over 30 years. Our second presenter is Marshall Davis. He's the CEO of Davis Law, a Bucks County law firm that serves the Philadelphia area and the suburbs. Also, he's licensed in New Jersey. And very interestingly, his practice includes business law and commercial transactions, and also nonprofit law. He has done a lot in the real estate tax assessment area also. So with that, I'm going to stop my part and pass it over first to Steve Wilson. Steve?
Thank you very much, Ed. Appreciate it. Good morning, everyone. Marshall and I today will help you through the process of selling a business. So, of course, you're going to ask, well, should I sell now or later? But here are some of the areas that, or some of the reasons why you'd want to sell a business. One of the most popular items, of course, is retirement. And a lot of people will go and play golf, maybe, volunteer for SCORE, or go on vacation. It's one of the more popular reasons to sell your business. Another reason would be some financial reasons that you might have, or some health issues that came up that are forcing you to sell. Or there could be another business opportunity that comes along where you could take advantage of your profit from selling your business, buying into another business. Another area that you might want to think about is if you have an employee that has experience in your business and may have the funds to buy your business, you might want to sell to him. It would be an easier transition if that's possible. Of course, a lot of people want to spend more time with the family. That's another very good reason to sell. The time is right when you think it's right to sell. Where to look for a potential buyer. So you can look at a potential employee or a customer or a competitor and work through your own networking. Now, I call this a private sale. This is where you may want to save the fee rather than going through a business broker, which I'm going to go through in a few minutes, which usually has a fee of about 10%. So if you have a chance to sell to an employee who has that experience and will keep the sale confidential until it might go through, that's a great opportunity for you. You also may have a customer that you have somewhat close relationship with that you can talk to confidentially, that you're looking to sell your business, and they would be a good match for it. And they might have the financial ability to buy the business. Another area would be a competitor. Now, this would be a competitor that you have some type of decent relationship with, that you can trust, and it would be a good match to merge your business into. The area of going to an employee or a customer or a competitor is very, very risky. You're walking a tightrope here. Potentially a buyer has to keep this very, very confidential and not let it go out to anyone else if you have a conversation with them. You have to try to determine if they have the financial ability to buy. So if they're serious about it, you want to get some financial information from them. They're going to ask you for what kind of price you want to sell your business. Give a wide price range. Don't give anything specific that they'll hold you to. This is just the beginning phase of trying to sell your business into a private sale. Also try to figure out if the employee or the customer or the competitor has a pretty good knowledge of your industry. That would help making it a really good match. Also, you want to sell the idea of the benefit to either the employee, customer, or the competitor, the benefit to them of buying your business. Be prepared to give that information. If the sale starts to work in your favor, you've got to start bringing in your accountant and your lawyer to start preparing some papers, but only if one of these people are very serious about going forward. I tried this 4 times before I sold my business. I almost got one of them, but at the end, they backed out. So that's when I went to a business broker. Steps to get ready to sell. If you are thinking about selling your business, think about 2 or 3 years ahead of time. On the average, it takes about 1 full year to sell your business. That is finding someone that's ready to buy and then going through the whole process. So if you think about it a couple of years in advance and you're really serious about selling your business, start to think about strengthening any weak areas that you have in your financials or your operation or your sales or any of your employees that you might have. If you start, let's say, 2 years in advance and realize I've got some weak areas I have to work on, you're going to be much more prepared to sell your business. And you want to showcase that business when you're ready. You want to make sure that you have all the customer service and benefits to your customers that you can showcase to the potential buyer. At this point in the process is when you have to start thinking about the value of your business, how to come to that value, which will, of course, help you price your business. Now, there are several different formulas out there that the accounting firms or the business broker or a financial advisor will gravitate to. And it depends on the type of business you have, how big or small it is, but you want to contact your accountant first to start talking to him or her about what type of value you can put on your business and then create a sell price. Now, there are a couple of other things though, when you're determining the value, it's very important that you can add these factors into the value of your business. It will be the length of time in your business, the customer mix that you have, the product or service line that you're selling, the geographical location of your business, the management team, the reputation in the marketplace. All of this comes together under a heading of goodwill. And depending on how strong those factors are, will depend on how strong your goodwill is and how that will add to the value of your business and then the price of what you're going to try to sell it for. It's very important that you keep the sale quiet. Now, even though I said to you that, there could be an employee or a customer or some competition, in general, you have to make sure that you keep your sale as quiet and as private as possible. If you let this out to your employees, I almost guarantee that there's going to be some negative rumors that are going to start, and some of your employees will not understand that you're trying to sell it and that maybe they will continue to be employed by the new buyer. Some of them will start thinking about looking for another job. With customers, if they find out you're trying to sell your business, they may start looking for other sources of product, and then they'll go to your competition maybe, and then the rumors and the gossip will start about you. You may be going out of business, you may be going bankrupt. It just happens that way, rather than saying that, well, they're going to sell their business to someone else. It doesn't work that way. You really have to keep it quiet, even to the general public, as best you can. That's why it's in case you do go to an employee, a customer, or a competition, and if they're serious, you're going to have your attorney create a confidentiality agreement that they must sign before you go forward with anything. Why sell with the to a business broker? The business broker is one of the most popular ways to sell your business. It's not the only way, but it's really the most popular way to do it because they're the matchmaker here. They're going to interview you to determine whether they want to take you on as a client. They don't want to waste their time if you're not serious in selling your business. If you are, and they take you on, they're going to ask for your financial information. They're going to ask for at least 3 years of P&Ls, balance sheets, cash flow, your income tax. They want to see how strong you are. They're going to help you with the value of your business and with putting together a price for your business. So you're going to try to hire the right broker. You're going to try to find out if that broker has knowledge of analyzing financial statements. You're going to try to find out if they have, right off the bat, potential contacts, potential buyers for your business. Make sure that they are a local broker within your geographical territory. They charge the seller, you, a fee of approximately 10%. Now that's 10% of the sell price at the time of the closing. That's a lot of money. So that's why you may put more emphasis on trying to sell the business on your own before obtaining a business broker. If you can't, then I strongly recommend you find the right kind of business broker. Now, they will also help you negotiate through the whole process. You want to make sure that they have knowledge of your industry. They're going to ask you a lot of questions. And then you want to ask them, how are they going to advertise your business out into the market? When they bring you a potential buyer, they will make sure that that buyer signs a confidentiality agreement in advance of them getting you the name of your company and any of your financial information. During the initial time of working with a broker, they will have you and help you put together a selling summary of your business, the history, your product lines, your customer base, your financial information. It's kind of a broad summary without your name on it that will go out to potential buyers. At that point is when the broker sits down with you and starts to put together a purchase price for your business. It's very common that the seller tends to overprice his business. Now you're trying to maximize your profit on what you're going to sell the business for, but you don't want to overprice it and then have buyers think it's too much and walk away and not be able to bring them back. So a lot of time is spent with the broker and with your accountant to develop the right purchase price going out into the marketplace. I also put in there selling through your network contacts. This is important, if during the time frame that you're with the business broker and he's trying to sell your business with his contacts, if you find a private sale, you know someone that's looking maybe to buy your business at the same time that you're under contract with the business broker, be aware that he will get a percentage of that sale. So anything that goes on during the time, and it could be, let's say, 6 months that you signed on with a business broker, great. If you find someone that's interested and he didn't know about it, but you're going to have to bring him into the process. After you've set everything up with the broker and you're ready to go out there, and now the buyers are going to come knocking at your door. The broker will contact you in advance and advise you what type of potential buyer they may have. And they will actually scrutinize the buyer before you to see if they have enough cash or have enough ability to take over your business. You're going to have to give up all your financial information to that buyer. So the profit and loss statements, your balance sheets, cash flow, and income tax, usually it's about 3 years worth. So you want to have that prepared in advance. Now, when I wrote on here, show all profits, one of the things to think about is small businesses sometimes don't show all of their profits so that they don't have to pay as much taxes on those profits that they need to. But if you think about selling your business a few years in advance, think about showing as much profit as you can, which in turn will allow you to sell your business at a higher price, because that's one of obviously the things that the buyers are looking for is your profit trends. Now is the time to have your accountant and your lawyer ready to go, because there should be some, or hopefully there will be some letters of intent that will come in from some potential buyers. Marshall will go over some of the detail of the letters of intent, but that's where the buyer's attorney will put together a letter in detail of how much they're looking to purchase your company for, and what types of payment terms that they're willing to go forward with. Be prepared with the payment terms. If you have a buyer who's going to pay full price, that's great. It doesn't always happen that way, but you're lucky if you have someone to do that. But quite often, there are potential buyers that have all the experience, but don't have enough cash for the full amount. So they're going to want to negotiate a down payment and hope that you take a note payment on the balance of the sale. So for example, if you were going to sell your business for, let's say, around $200,000, and they came in and said, look, we can give you $50,000 down payment, and we can pay off the rest over a period of 3 or 5 years. That is very, very common in selling your business. You should be prepared for that. Now, if that happens, the seller has their own due diligence. So if there's a buyer who wants a note, the seller has the right to minimize the risk that they're going to have to take. Now, what you're thinking about here is, well, how do I minimize my risk? How do I make sure that I get paid over that period of 3 or 5 years that the business hopefully is going to be working the way it should, and I'm going to get paid back? So here's some of the things you want to think about. If they come in with a request to take a note, for you to take a note, which, by the way, your accountant and your lawyer will put together, ask for a little bit of a larger down payment. If they say they're going to put down 20%, ask for 25%. You can also, at this time, because you're taking that risk, you can potentially increase the purchase price to a certain degree. You're right in the middle of negotiating. Now, and there should be a fair interest rate that you're allowed to charge on that note. You're also, your attorney is going to request a personal guarantee. That's very, very, very common. Also, you're going to request a security agreement to recover any buyer's assets if the note is not paid at a particular time. Now, the assets could be some assets of the business that you're selling or personal assets that the buyer has. So you've got to negotiate that through and make sure that that is a written agreement done by your attorney. Also, you have the right to check the buyer's financials because you're taking the risk. Again, this is a very common thing to do. You want to ask them where are they getting the funds to buy your business? What is their credit rating? Now, on their end, if you're a buyer, you want to get your credit rating as high as possible, and the seller is allowed to ask for that information. Also, the attorney can help find out if the buyer has any lawsuits against them or any defaults by a bank. And that's going to help you determine whether this is too much of a risk going forward here. One other really important thing that I think some buyers forget about is they may have enough money to put a down payment down, but do they still have enough working capital? Because they're going to need that, especially the first 3 months that they buy the business before they start having any cash flow coming into the business. So ask them, how much working capital do you have? And do you have a business plan? And you have the right, again, if you're giving, you have a right to read and look at their business plan that they have written up. Now, what's important is that you get ready for the buyer's due diligence against you. So I'm going, in the next 4 slides, I'm going to give you my experience of what I went through several times as a buyer in the types and a seller of the type of questions that you go through with due diligence. The due diligence is where there could be a deal breaker. So be very, very prepared for the following list. But before I mention that, I want to mention that also be prepared as the seller that you may be requested to sign a non-compete. The buyer doesn't want you selling the business and then going down the street and becoming a competitor in some fashion. So in the non-compete, there could be what products that you will not be allowed to get involved with after you sell the business, the geographical area that you're not allowed to maybe start a business or get involved in, and the number of years of the non-compete. You're not requesting that. Their lawyer will potentially, probably request a non-compete of you. Be prepared for that. Now, I have 4 slides. I'm just going to do something really quick. So there's 17 areas here in the buyer's due diligence. You as the seller should be prepared that the buyer has the right to ask all these questions that I have for the buyer's due diligence. And if the buyer doesn't know about all these, I'm sure that their attorney will also bring this up for the buyer to start spending, could be days, weeks, maybe even a month, going through all this due diligence that you want to be prepared for. So they're going to talk about what kind of structure you have in your business. They're, of course, going to have looked at your financials and maybe look further. They're going to want to sit down with you and go over your computer systems. If you have like QuickBooks, they're going to want to look at how you invoice customers. They want to see what kind of accounts receivable, how fast you're collecting your accounts receivable. Are you paying your payables on time? And then, of course, going through all your expenses in detail. They want to look at whatever physical assets you have. So I put down inventory, equipment, computers, any vehicles, office furniture. They have the right to go over that with you. Your facility, probably one of the most important things is if you're renting or leasing, then now's the time to start talking to your landlord to make sure that they're on board with the potential buyer and have them meet so that there's no issues at the end of a potential sale. If you do have employees, you should be prepared to give a job description, like a one-page job description. Also, any benefits that you give to your employees. Competition. Now, they've probably already gone over this with you, but they're going to do their own checking of any other competition that you didn't tell them about. Or if so, make sure that you give all the information, all the competition that you know of. On your suppliers, realize that the vendors that you deal with do not have to give the same terms of sale to the potential new buyer. It would help if you introduce your buyer to your main vendors and try to make sure that that relationship goes forward. Any contracts that you have, any that you have signed off on, the buyer has the right to get a copy of every single one of those to scrutinize it. Go over your insurance coverage. Going to the customer list, try to make sure that you have a really good customer mix that you're giving to the buyer. If you have 1 or 2 customers that have a volume of about, let's say, 80% of your sales, that's going to be a really potential deal breaker there, because if one of those 2 customers, which you've been dealing with for a long time and you're doing a lot of business, but if they don't care for going with a new buyer and that buyer may lose that customer, you've got an issue here. Do your best to have a strong customer mix and a really good reputation in the marketplace. The buyer has the right to then go into your files and look at all the customers that you're dealing with, but they don't have a right to call those customers before the sale is consummated, okay? If you have any international business, that's important that you're going to have to give that information out. Any trademarks or copyrights, all your licenses and permits, be prepared to show that to the buyer. The sales tax is, if you have sales tax in your business, the sale will not get closed until you can prove that you've paid all of your sales tax to the state, to federal, and so forth. This is really, really important that you make sure that you have no sales tax in arrears and any issues with any type of taxes. And if you have any litigation, be prepared that they're allowed to ask you about that. And they're not going to assume that litigation, but be prepared to talk about it. So any one of these issues could be a deal breaker for you if you're not prepared for that buyer. You've gone through everything here. And if you don't have any cuts and bruises as you go through all that due diligence, then you could be ready for making a deal. Now you bring in, now your attorney has been with you all along, but now you got to bring him in to start the buy-sell agreements and all the other documents that are necessary to make this go. So I thank you for your time and good luck on selling a business. And now I'm going to turn it over to Marshall to go over all the legal documents. Thank you.
Hi, everybody. Actually, before we switch to me, it looks like there was a question for Steve from Oleg Bond. It says, what are the methods of business valuation?
There's quite a few methods of business valuation, and it really depends on what kind of business you have. And you should contact your accountant on that right away, because that is so important in the very beginning stages. If the accountant is not prepared to really, really help you with that value, if you have a business broker, they will be prepared most likely. And if you have a financial advisor or know of one, then try to work with that advisor. So it's one of the hardest things to do in the beginning stages of your business, of selling your business.
Right. We'll hold all the rest of the questions till the end. This
okay.
way, only because Marshall may be answering some of the stuff also. So we'll let Marshall begin.
Okay, sounds good. So my name is Marshall Davis. I'm an attorney with Davis Law, practice in Pennsylvania, New Jersey, and federal court. A little bit on my background because it's relevant. I was an accounting major, and in addition to my law degree, I also have an MBA and an LLM in tax. And what that means is I really understand all the aspects of these transactions. And it's my job to advise the client and help with the business terms of the deal. But once those business terms are decided, it's not my job to kill the deal. I'm there to facilitate the deal and to protect the interests of my client, to make sure that they're getting paid and they get the best bang for the buck. So I'm going to start off with the very basics, which is a confidentiality agreement or a non-disclosure agreement. And that's critical because if you're talking about selling your business, as Steve talked about, one of the last things that you want to do is tip off competitors that you might be selling. So that's something that everybody needs to do at the very, very beginning. And if you don't have that confidentiality agreement, then really people can take your information and use that to hurt the business in various ways. Another question, another thing to discuss at the beginning is, when do you time a letter of intent? So a letter of intent is usually something that's non-binding, that gets the parties to put some sort of skin in the game. So you might have been talking to the parties formally, informally, but once you start getting the terms of a deal framed out, that's when you want to start getting an LOI agreed between the parties, so that at least the framework of the deal is there. So if you have an agreement on the purchase price and the financing, that might go into the letter of intent. Usually it's vague. Usually if you're the seller, you're going to want a down payment, and the down payment should be forfeited unless you fail something during due diligence. So those are all kind of the things at the beginning. But to go back even before that, to maximize the sale, one of the most important things is that especially in a service business, that you're not selling yourself necessarily. If you are the value of the company, it's going to be hard to sell the business and maximize that sale, because you might stay on for a few months and help with the transition, but they really want to buy a going concern. They don't want to buy a person. So that's something that's absolutely critical, to make sure that your business can run without you. And yes, there's going to be some training involved and some, getting them transitioned, and that's usually something that's agreed. But you still need to have that business run. And those transition agreements can be employment for the owner. So it could be a nice way to still make some money afterwards. It could be 6 months, it could be a year, it could be a month, could be several years. Those really vary. And those are other ways that you can really sweeten the deal, and get some going income. Another factor to consider is, do you own the land where this business is? Do you own a building? Are you going to sell the building, or are you going to rent it out? All these things can affect the tax. If you're going to get slammed with a high tax bill, versus maybe spacing it out, if you're going to be renting it and not selling the assets. Those are key things, and it's kind of hard to talk in general about them because every situation is different, but those are some important things to consider. I also have a couple of questions here that relate to this time. Can you discuss the pros and cons of stock sales versus asset sales? My structure is a single member LLC. So this is also something that would be its own whole presentation, but I can kind of touch on it. As a seller, a stock sale is generally better if we don't consider taxes. A stock sale is generally better because you're selling the whole business, and if they're buying the stock, they're buying the liabilities with the stock. With an asset sale, usually the buyer wants an asset sale because then they can buy just the assets and not buy the liabilities. That said, most transactions happen to be asset sales because most buyers don't want to buy a bunch of unknown liabilities. So to get around that, sometimes it's important to have the stock. For example, I had a transaction where my client was buying a coal mine. So there was lots of licensing and other issues that were that would make it much more beneficial for them to just buy the entire business. So they wouldn't have to get relicensed. So that was one example. I have a client where they were buying the business, and they were the manager of the business for like 7 years. So in that case, they knew the liabilities and they didn't have to renegotiate some contracts. So for them, it was better to do a stock sale. There's also significant tax differences, which really depend on a lot with your individual tax situation. So with that, that's really a question for your accountant, but that can vary a lot. But if you do a stock sale, you can still make what's called a 338H10 election, which is the ability to have the sale treated for tax purposes as an asset sale, not a stock sale. So you can kind of have the best of both worlds. Another question, in S Corp, will sales and city licenses just transfer over? If not, is this something the attorney would help with? Yes, that is something that I would help with. If it's a stock sale, generally those licenses do not transfer over. If it's an asset sale, they can transfer over. So that's part of what's critical about making that decision. And those are things that can also affect purchase price, because if you don't, you might be okay if you're the buyer absorbing some of the liabilities if you don't have to go and get relicensed. At the same time, if you're the seller, you might not want somebody doing business under your licenses because your name might have been personally attached at one point. So these are all huge factors. Steve talked a lot about the business brokers, and yes, they have their place. But one of the issues that attorneys have with business brokers is different loyalties, we could say. Attorneys have a fiduciary duty to act in their client's best interest, whereas with the business broker, their goal is to sell the business. So they get paid on that sale price, whether or not there's a lot of risks involved. So one of the ways that attorneys often butt heads with the business brokers is that the business brokers get paid on the total sale price generally. Usually people aren't paying cash for a business. So that means that a big portion of that business is held in a note, often by the seller. So if they pay 20% up front and they pay the rest over time with the seller, if they default and don't pay the seller, the business brokers still had their 10% on the total sales price. They usually don't get their 10% as the payments are made. So they really don't care what protections are in there for the seller. Whereas the attorneys, it's our job to make sure that there's protections, that there's a good note, that there's security. Security could include a mortgage. It could include liens on the business assets, a whole load of different things. So those are ways that really need to be done. Those are things that need to be done properly to really protect the client. Another thing that comes in during these early discussions on the structure is that is there going to be some sort of clawback provision? So sometimes the purchase price might be $1 million, but then there's a provision that if the business doesn't do as well in time, there's a reduction of the purchase price over time. That's especially if something's like a financial planner kind of business or a service industry. There's also sometimes ways that you can say, well, if that's the case, if the business does better than anticipated, we're going to actually increase the purchase price. Those things usually don't affect the commission that the business broker gets, but they can obviously have significant implications on the seller of the business and how much money they're going to get. Once all of these terms are done, either due diligence will start, and then we'll do an asset purchase agreement or stock purchase agreement, which is the main document that controls all of this, or we'll do the asset purchase agreement or stock purchase agreement, and that will have a due diligence provision. That's really just more of a timing issue than anything else. Steve talked a lot about due diligence and covered a lot of that. And unless there's any questions on the legal aspects of that, I think I'm going to skip some of that to focus on some of the other areas because like I said, he really did cover that well. But some of the legal aspects that I'll just mention on the due diligence are reviewing those tax documents, checking licenses, checking the entity to make sure the name's registered with the state, to make sure that the entity is active and in good standing with the states. Environmental issues. So as a business owner, you need to be aware of these things and think, and generally buyers are going to be a little sophisticated, at least if they're buying a business, and they're going to want to check things. They're going to have environmental phase 1s or phase 2s. They're going to have property inspections. They're going to have essentially audits of the business. So that's where it really comes in as the owner. You don't want to be cutting corners, because I've seen so many deals blow up because of $30,000 underground oil tank, for example, that might be leaking. And that's a $30,000 cost sometimes. Even if it's $1 million business and $30,000 isn't that much in comparison, it then sends up a red flag of what else are they hiding. Another thing that business owners really need to consider that can affect the value of the business is whether or not their books and records are clean. A perfect example was that I was involved in a transaction where a client was buying two separate franchise territories. The one territory was large. I think it was about $400,000 was the sale price. Everything was clean as far as the books go, everything tied out, and it was great. The other territory, the financial records didn't match the tax records, and nothing could be tied to the bank statements. So eventually, the client didn't buy that business, and that seller, who was a different owner than the other territory, just didn't sell the business, and to my knowledge has still been unable to sell the business because none of the financials made sense. So it's really important to have a strong CPA and make sure that all of your records make sense. And that means you're keeping separate and adequate books and records according to GAAP, the generally accepted accounting principles. Usually in QuickBooks or some other sort of software, you file your tax returns on time. The numbers in QuickBooks can be tied back to the tax returns and reconciled. And if you pull random transactions in bank statements, they'll tie out. I've seen other deals that go belly up if they start pulling transactions and they don't make sense. For example, I had a client that got essentially ripped off because his partner was doing some things. So we went to look at the books and saw that there were entries in QuickBooks that had names of different vendors. And when we would pull them, we would see the actual checks, and they would be checks to his kids, his wife. The liquor store was a common one. Charter fishing yachts was a common one. And it was hundreds of thousands of dollars of transactions like this where they were booked as one thing. But when we got the bank statements and saw the actual checks, it was something else. And in that situation, the business is going to be either unsellable or sold only at a significant discount because people aren't going to want to take that over. Another example is cash. So I represent a lot of restaurants. Restaurants are notorious in dealing with cash. I tell them that that's not a good idea, not only for security, but also if you are not claiming the cash, then you can't essentially use that to value the business. You can't use that for a loan. People were hurt in the PPP and EIDL process because they were dealing with cash and they didn't show it on the books. It's also obviously illegal. But another thing that blows my mind is that a lot of times cash businesses will pay their expenses in cash. Meaning if you're paying it in cash, you really can't deduct it because you don't have proof of that in general. So there's not any advantage if your business brings in $100,000 of cash and pays out $100,000 of expenses. Generally, if you just claim that cash and then as income and claim the expenses, it's not going to make a difference tax-wise, but you'll show it and you'll be doing the proper thing, and that can count for the revenue if you're going to go sell the business or try to get a loan. And I've seen it many times where businesses are actually paying employees and paying other expenses in cash, and it really doesn't give them any benefit. They can't write it off, and it creates problems. And in the sales situation, aside from the obvious problems, what some people don't think about is that how do you know how much cash is actually there? So what we'll normally look at is if you're the buyer, for example, and I know this is a presentation on sellers, but you need to think about the buyer's perspective and their psychology to really maximize your profit. The buyer is going to consider any cash that you claim is coming in as zero, essentially, because if it's not claimed on your taxes, how do you know it's there? And any expenses that are paid in cash, you need to include, because if you're the buyer, if you're going to be buying the business, you're going to want to be running it properly usually, and you're going to have those expenses. So it can really be a double whammy where you don't count the revenue, but you count the expenses. So as a seller, what that means is that you really need to be doing your books the right way, claiming the cash, paying the taxes on it, and yes, taking advantage of every legal tax deduction that you can, and every write-off that you can, but that doesn't mean non-reporting income. So one of the other big aspects of the buy-sell agreement is what's going to happen with allocating the purchase price. And what that means is all the parties need to agree on how the purchase price is allocated. This applies mainly to an asset sale. So what that means is that the IRS has different classifications of income, and they're taxed at different rates. And that's kind of an oversimplification. But so it could be fixed assets, it could be inventory, it could be non-competes. So for the seller, often the buyer is going to want a non-compete. For the seller, that means that there's value for that. So you should be adding to the purchase price for the value of a non-compete, and whatever that value is actually gets allocated to the purchase price as payment for a non-compete. The negative on that is it gets taxed as ordinary income, because essentially you're getting taxed not to work. You're getting paid not to work or not to compete. So the negative is that it's ordinary income, but the positive again is that that should be more money, because the longer your non-compete and the more strict it is, the more they should be willing to pay for you not to be able to do those things. Another factor is I touched on it before, but the promissory note. And what that is if the seller is holding back any of the loan. So in other words, if somebody puts down payment money and they need the seller to finance part of it, because maybe they're getting an SBA loan and the SBA wants that, so the seller has skin in the game, or they can only get partial financing. Whatever the reason, if part or all of it is held back by a note from the seller needs to make sure that they're going to get paid on that note. So sometimes the purchase price will go up if the percentage of a down payment goes down. In other words, the seller's taking more risk if they're getting less money up front. So there's going to be a premium paid for the business. There's also usually going to be interest charged. Right now, a common number is 5%, but it usually can't be below a certain amount, which is called the applicable federal rate, and that varies constantly. So that's another way, again, that the positive is you can space out the money. You're not paying tax on it all right away necessarily, and you can also make some extra money on the interest. Promissory note's only as good as how secure it is. So the promissory note means if the person doesn't pay, you've got some proof that they owe the debt, and you can go after them in court. You secure a promissory note with a security agreement. So there's all different types of security agreements. A mortgage is technically a type of a security agreement. So it's one of the strongest because you can foreclose on real estate, which has real tangible fair market value if they default. You can have what's called a UCC1 lien, which are liens filed with the on the assets of the business. So if they default, you can start taking back the assets of the business. If it was an asset or a stock sale, you can have stock powers or membership interest powers, which means if they default, you can take the business back. You can have anything that's of value, pretty much you can have security on it. And the way you need to think about it is, okay, if they default, I'm going to now have this asset and I'm going to need to sell it to get made whole. So yeah, computers are valuable, but in a couple of years, if they default, what are they going to be worth if you need to essentially foreclose on them and then resell them? Not much. So that's where you really need to think about what is the amount of the financing and how best to protect yourself on that. The note, you can also have clauses that they can't prepay without a penalty. Sometimes it could mess up your tax planning if you're going to have a lump sum and they're going to pay it off early. So you could have a penalty put in there. Another major factor is most people, if they're going to be buying the assets, they're going to be forming a new LLC or a corporation, and that will be doing the purchase. So that way they have a clean slate and they have the liability protection of having an entity set up. Now, that's all well and good, but if that business defaults, you'd be limited to essentially getting whatever assets are in that business to pay yourself back. And if they're defaulting, chances are pretty good that the business isn't doing well. So where does that get you? So that's where a personal guarantee is really important. You could either have them co-sign, meaning they're going to be equally responsible for all aspects of the business, or if they don't want to expose themselves as easily to third-party liabilities, they can just do a personal guarantee, which means the agreement is just with you as the note holder, that if they don't pay, if the business doesn't make the payments, you can come after them personally. And then you can then secure the personal guarantee as well. So you can secure it on their personal residence, their beach house, their 401k, their any of their other personal assets. So the personal guarantee is extremely important to have. Tax requirements are something to be considered as well. We kind of talked about advantages and disadvantages, and it's a little bit hard to cover that in general because it's such a broad topic. But one of the important things is that everybody agrees to allocate the purchase price the same way. Most attorneys don't even, that I've seen, don't even consider this, but it's actually a form in an asset purchase agreement that the IRS requires the buyer and the seller to file with their taxes for that tax year. So we actually have that drafted. I work on it with the client's accountant, and we have that agreed in advance. And what that means is each side is agreeing to the same breakdown, and the IRS is generally okay with that as long as it's reasonable, because both sides are treating it the same way. What they can't have is one side treat it advantageously and the other side treat it advantageously, and then there's a big gap of non-taxation, and that creates some problems. So it's important to get those allocations agreed beforehand, and when the other side doesn't pay attention to them, that's where you can also get some value and have some advantages in those negotiations. With that, I think there's a lot of questions, and we're running somewhat low on time, and I want to leave time for questions for Steve as well. So
Okay.
I'm going to wrap things up and start answering questions.
All right. Thank you very much, Marshall. I
welcome.
will, yeah, I'll look at the questions and I will give them to you or to Steve. The first one's kind of interesting. It says here, I'm struggling to identify a business broker with expertise in my industry, as local brokers or franchise brokers don't have any contacts specific to targeted strategic buyers and just want to do generic promotions on biz, buy, sell type platforms. Where could he go to find some business brokers that have expertise? I would think one of them is to ask his accountant, the other one is to ask his lawyer, because both of them have probably dealt with these people. But what are the two of you thinking?
Yeah, I don't want to ask your business type because your name is here, and we don't want to have some confidentiality issues with that. But if you want to private message me your business type, I could possibly set you up with a broker, or at least give you some suggestions of brokers that are in your industry. Sometimes it doesn't really matter what the industry is. Again, it depends on what the industry is, but sometimes people just want to take over a business. I have a client who was a CFO of a company and just wanted to kind of do their own thing and was just looking for businesses that had good numbers that they could run. And they ended up getting into the salon industry because there were a couple of opportunities, and now they keep buying salons and they have no experience with hair or spas. But you know what? They kept great people on and they're doing really well. So sometimes industry is not necessarily important, which is why we should probably talk offline. So if you want to contact me afterwards, I think they're sending the contact information, but I'm going to also send my email address right now through the chat.
Oh, good. Well, thank you.
Yeah, Eddie, I just want to add to that question that a lot of brokers obviously don't know all the industries, but if they are very good with analyzing financial statements, and you can verify that, that might be a type of broker that you could work with. And then, of course, try to find out what kind of contacts they have, or, what kind of matchmaking they can create with their contacts. But the knowledge of financial analysis is really important for the broker.
That makes a lot of sense. Here's an interesting question. It's two parts, but I think they go together. Do you know when we can apply for a PPP 2.0 forgiveness? And they've also heard that this PPP forgiveness can be an issue, I guess, in a sale. Either of you have any knowledge of that and how it works?
The PPP 2.0 forgiveness depends on the bank. I know some people have already been applying, but it depends. Most of the banks that I've dealt with, they'll send a link to the borrower when it's time. So it really varies on the banks.
That's what I thought. Here's another one. A key employee has expressed interest in buying my business and appears to have explored SBA financing to do so, but it's concerned he may not have a sufficient down payment for the loan. What options, I guess the word should be, do I have, as I want to maximize the valuation of the business when I sell it? Can I offer a note to the key employee for the SBA down payment? I'm not sure how all that integrates, because the
Wow.
SBA has all sorts of very stringent rules.
The first thing he should have is a confidentiality agreement from his attorney to have that employee sign off on before they go any further. And you're going to have to, be patient with the employee to see how he makes out with the SBA. You don't want to jump in with a business broker yet, because you can't really use a business broker and have the employee also looking to buy the business. You're walking a tightrope there with that employee.
What I would say is it depends. Like Steve said, the SBA has extremely strict requirements, so it's possible they'll allow a note. I know, in my experience, as the SBA likes to lend money when the seller also has skin in the game and the seller's also putting up a note. But whether or not the note could cover the whole down payment or not, that's going to depend on the bank and the SBA. It's possible. Especially things are changing so quickly in the SBA world with PPP and EIDL and all of those things. So I would say it's probably worth exploring. Absolutely 100% get the confidentiality agreement or NDA with the employee. Don't use the generic ones you can on the internet. Go to your attorney to get it. And from there, then you could even start setting up meetings with these guys at SCORE to maybe go that next step, maybe even bring the employee to a meeting and they can help kind of navigate with the SBA, but they can talk more to that.
Right. Okay, thank you for that. Here's one. When you are selling, this is interesting. Does the owner add back his or her compensation to the seller's price? Well, I assume that it's in the expenses, but I think in terms of compensating on top of the expense line, I wonder.
Yeah. I don't think so.
No, right?
I've seen it both ways.
Yeah.
So if the owner is leaving the business and not going to be needed anymore or replaced, then often actually, yeah, I have seen that added, because that's an income stream that really, yeah, there's an expense, but you can add back the expense, kind of like you add back depreciation often. But the flip side of that is if that person needs to be replaced, then the buyer is going to want to factor in that new expense. So I actually have a SCORE client that I've been working with where they're trying to sell their business, and the business grosses around $3 million a year and it nets around $1 million a year, but a lot of that is paid to the owners. And one of the things, and obviously that's an amazing margin. And in the valuations, they're adding back that $1 million that gets paid out. And the difficulty is the two owners are going to probably need to get replaced by 4 highly compensated individuals. So the question is, how high is highly compensated, and how much of that is going to get eaten up by those new salaries? And that's where there's a lot of play and a lot of questions and uncertainty.
Here's one that's interesting. The COVID plays a part. I'm a business owner of a franchise and I want to purchase one that closed due to COVID. After signing an NDA, the only financial information they could give me was the tax returns for 2018 and 19, which I guess we found, that their books and records were not clean. What advice would you give me in regards to buying the franchise? That's kind of, if the books and records aren't clean.
Yeah, then.
Tough thing to do, to work with, especially since they're 2 years old to begin with.
Right.
Sounds.
I guess a forensic accountant is what you need to look and to see how they would really look clean, if you know what I mean.
Exactly. I've worked with forensic accountants for this very thing, and it comes down to deciding whether you're going to either walk away or try to buy it at a bargain purchase price. But what I say is, you still are going to need tax clearance certificates and all sorts of those things to make sure that there's no outstanding taxes. Because if it's, say, worth $500,000 and you're going to buy it for $100,000, well, your risk isn't that $500,000 for the value or the $100,000 that you paid. The risk is, what are the outstanding liabilities? And that could be hundreds of thousands or millions of dollars for tax liabilities, environmental liabilities, all sorts of other things. So even if you got it for $1, you might get it for $1 and be stuck with an insane amount of liabilities. So there's ways to protect and reduce the risk, but it really depends. And to answer the question, I'd probably need more. I would definitely need a lot more facts. So you could contact me offline.
Right. Here's one. Our business, like many others, took a big hit in 2020. I would like to sell my business. Can you sell a business with only 100,000 in revenue? I think you can sell almost anything. It's a matter of what type of business and what your revenue stream looks going forward. Steve, what do you think?
Well, sure, you could sell it, but try to show if you had some profits in previous years, try to showcase that in your selling ability. So many people know that people got hurt during the COVID period, but you can sell that low amount. There's no reason why not.
And that was the revenue line that they mentioned. I don't know what the net income line would be, but if you would taken 20% off that, so you'd get 20,000 in net income, that wouldn't be bad if you're looking for a small side business.
Yeah.
But you need to look at the books a little closer. Okay, here's a question for you. You answered it before, but it comes up a lot. People are always looking to buy pizzerias / restaurants, and those are heavy cash businesses up until the time of the sale, when they tell you it's a great business and you really want to pay me $10 million. How do I go? And these people, the sellers, usually, unless they're using professional help, aren't reconstructing the books the way they should be looked at. How do you go about evaluating that? I know it's not easy, but do you stand there for a month and clock the number of pizzas that go out? I know the IRS counts the number of bags of flour to figure out how much they're cheating on the number of pizzas. I happen to know somebody who went to jail for that. So there are ways, but Marshall, what do you do when somebody brings you this?
So it's actually a great question. I have a client who is, I'm trying to protect confidentiality. They're the largest franchisee of a certain well-known restaurant in the country. And they're trying to get into a different type of restaurant just to diversify it. So they've actually been doing well, most of their locations, even through COVID. And the direction they want to expand into is pizza. And so over the last 3 years, before COVID, during and after, we've been exploring this very question and encountering this. And they've been looking at everything from buying little pizza shops to buying some franchises to buying some independent ones, some bigger ones, to most recently, we looked at buying a small franchise that had some corporate-owned locations, some franchise locations, and one licensed location. And this is exactly the issue that keeps coming up. And my client they're very savvy. They do a lot of due diligence. And part of the due diligence for most of these deals is that they get to send their people into the restaurant for a month to literally count ingredients, count sales. They look at the cash register receipts. They look at the POS receipts. One of the things that I've also alerted my restaurant clients to is if people are knowing that they're going to sell, you need to do spot audits, especially on large purchases, because, pizza restaurant, you're going to have purchases for dozens of dollars, maybe a couple $100 every once in a while. But if you're getting large purchases for thousands, okay, were they legit catering orders? Or is that the owner putting their own money into the register to pay tax on it, but knowing, okay, well, I'll pay a little tax on it now, but that's going to bump up my purchase price because I'm increasing my sales. So that's kind of the other end where they're claiming more money than is there. So my client will do exactly what you said. They will count the inventory, factor in the waste, have experienced people in the restaurant, writing down orders with full access to the POS systems and the cash registers and everything else. And they'll reconcile the registers, the POS, the bank accounts, the tax returns, the QuickBooks statements, and everything else, and spot check everything. So everything needs to tie out. And if things don't, then they either walk away, or if it can be factored in, they reduce the purchase price, because essentially, I take the safer approach. If it's cash, you just have to assume the worst. So in the revenue side, you have to assume the cash is not there and you have to take it out. And on the expense side, you really need to be there to see cash, because a lot of the pizza restaurants are, for whatever reason, paying their employees in cash. So yeah, they save a little bit on taxes, which is illegal anyway, but they're losing the write-offs, and then they're not able to even get the PPP loans on those people. So it doesn't make sense. It costs them more money to do it that way. It's a strange school of thought, but I encounter it all the time in the pizza restaurants. And my client is completely above board. Every penny, even give a penny, take a penny, is literally counted in their books. So they don't want to mess with any of that. They're very clean, which is unusual for the restaurant industry. And so, yeah, they check and check and check.
Most of those businesses are run by immigrants, and they all come from countries that are horrendously corrupt. And so putting the cash in the drawer instead of reporting it is the way they did business there, and they just carry it over. And then they can't understand why you can't understand that, which is half of the problem. And I've encountered it myself. Steve, have you run into anything like that? But the businesses you were in were all above board. I mean, selling ladders and all of that business kind of material.
Yeah, luckily everything was with credit cards and checks, so we didn't encounter any of that.
Right, yeah. That cash thing is a real problem.
It is, it sure is.
Let's see, we have another question here. Let's see if I can get this to come up. Here we are. Is there something sellers do to beef up their EBITDA number and margins that you typically find when you do due diligence? I mean, outside of putting money into the register and things like that, all of a sudden more purchase orders seem to show up. And
yeah, and there's no typically find on due diligence, because due diligence is only as good as, the attorneys usually will spot the things that you need to do on due diligence, but the attorneys usually aren't doing the due diligence themselves. You've got the accountants looking at the books. You've got the business people looking at the business items. You've got the environmental people looking at those things. So, you know, if an accountant isn't used to doing these transactions, they're not going to find anything. But yeah, putting the money in the register, beefing up orders. There's a lot of things with timing of end of year. You know, you can play some games. By can, I mean you literally can. You legally can't or shouldn't play games with messing with dates. So they might push off expenses into the next year. So if they know they're going to sell in 2021, well, the most current tax return they'll need is 2020. So they'll want to get as many collections run through in December and push off any expenses until the next month. So that's where you need to see year to date to see if, you know, there's low revenue or high expenses. They might have offered employees, oh, prepay. If you prepay, you'll have, you know, we'll give you a discount just so they can push that revenue into that year. There's sometimes completely legitimate reasons for doing these things. But these are also some illegitimate ways that are, it's not rocket science. It's if the accountant knows what they're doing, they can find it. I mean, prepayments are a short-term, usually a short-term liability on the balance sheet. So it should be there. The issues are if those numbers aren't coming up, and that's where you need to reconcile to make sure that the books match the tax returns and you spot check the bank accounts.
Right. Steve, did you run into that when you saw, I mean, you didn't do it, but when you were looking at businesses to possibly expand and whatnot, when you had your business, did you notice a lot of that or?
We saw some of it, but we really spent a lot, our accountants really spent a lot of time on due diligence. And as Marshall said, double checking invoicing and accounts receivable and all of the bank accounts to make sure that they all match properly. That's really what so many of the accountants are doing. They're double checking to see if everything works right. You know, if getting into the bank accounts and so forth. So the seller really has to be prepared to give all that information out, or the sale is not going to go through.
All right. Go ahead.
Oh, and it looked like Sean had a part two of that question. You asked for cash and accrual P&Ls to pick that up. That's usually an accountant thing, but I think it usually depends on whether they're a tax or accrual-based taxpayer. And usually they're cash, so everything is cash. I've actually seen on due diligence somebody playing games with and mixing up cash and accrual, depending on which statement it gives them a better answer, and which year it gives them a better answer. You know, 2018 might have been great accrual, so that'll be accrual. 2019, a lot of cash came in for the accrued revenue from the year before, so then you'll get a cash basis for 19. I mean, those are all things that are highly unethical, that if I had a client pulling that, I'd fire the client. And that's where you can get into fraud allegations and have major problems after the sale. So cash or accrual, I would say it depends on how the tax returns are filed. Again, usually everything would be cash. And if it's accrual, we would want some sort of accrual to cash reconciliation to make sure that there's not, invoices just pumped up in there.
Okay. We have one last question, actually, because we're right at our appointed hour. How do I sign up for SCORE mentoring to help sell my business and also find the right specific SCORE mentor? If you go to our website, buckscountyscore.org, and you put on there, find a mentor, and then there's some prompts and some questions, and they'll get the right person to you. Okay, it's just that simple. So with that, I'd like, first of all, to thank our two panelists, Steve and Marshall, for excellent presentations. This is the second in the series, the first one being how to buy a business, and this being how to sell one. And so you all remember, this has been taped, so it's in our library, and you will be receiving a copy of the tape presentation along with the copy of the slides. And as I said, it's all of the presentations we've had so far this year are in our library. And if you can just go to that buckscountyscore.org and go to the library, you'll see all of the things that we have in there. So again, thank you, everyone, and thank you, panelists. And we will see you next week for our next presentation, which happens to be on June 1st, 7 ways to organically grow your Instagram following. Thank you again. Thank you, guys.
Thank
Bye-bye.
you, guys.